Hello, Saiza. Good
Hi,
morning.
good morning. Hi, good morning. How are you?
Hello, good morning, sir.
Hi, good morning. Sorry for the delay. I think there was some firewall issue, and that's why I'm logging in from my phone.
Alright, no issues,
No
sir.
problem.
So, I guess since everyone's here, we can begin our meeting.
Yeah,
Okay. Today, welcome to today's episode of Investza's monthly market updates, where we bring to you industry experts to guide you and help you with your investments. Today, we have with us Mr. Sahil Kapoor. He is the head of products and market strategist at DSP Mutual Funds. He has a wide knowledge about market dynamics and behavioral finances. He has a guiding voice for investors navigating the complexities of mutual fund landscape. Known for his clear, pragmatic insights on systematic investment, market myths, and long-term wealth creation, Sahil helps decode the market noise and truly reveal what matters most. Once again, sir, thank you so much for being.
thank you.
I'll start off with some questions. How do you view gold and silver as part of your diversified investment portfolio in today's market environment?
Sure. So I guess that this question has two parts. One is that how do you view gold and silver, and then you also said today's market environment. So I would say that as investors, we should not be concerned with today's market environment. Gold particularly is a very useful asset for diversifying away from what we have. So think about it. From the point of view of emerging market investors. See, in all emerging markets, there is a big problem of currency depreciation. And why does that happen? Because in most emerging markets, the institutional structures are not so strong. So from time to time, you have problems like elections or balance of payment crisis, inflation issues, wars, etc. So these things cause a lot of depreciation of currency. So, asset like gold helps you diversify away from assets which get impacted because of depreciation, like stocks and bonds, and gold which benefits from it, right? So, it can be a very useful diversifier in your portfolio, and it should always be there in some sense. Now, the point is in today's market environment, I think if you look at the returns for gold and silver this year, they are more than 50% each. 50% for gold and about 65% for silver. So I would say that this is not the time or the day to, go whole hog on buying gold and silver. In fact, you should be doing the opposite. You should be sort of rebalancing what has done well and
Yeah.
looking at things which are fairly valued today. So from a very long-term perspective, I think it's a very, very important asset to have. But from today's perspective, as we stand here, if you are an investor who never bought gold in your life, today is not the day to buy. Probably you can, think about starting a SIP. That could be a useful idea in purchasing gold or silver. Uh, Primarily, I think if you're a new investor for precious metal, you should start with gold. And for today, I think it will only be logical to start a SIP and not invest lump sum.
Right, right. Got it, sir. As you spoke about the price movement in gold and silver both,
Yeah,
what are some key factors driving this price? If you could
sure.
highlight this.
So this cycle, I think we started writing about gold and silver about 2.5 years ago. And at that time, they were trading at a fraction of the price that they are today. And the primary hypothesis when we started writing was the following. One, that both gold and silver were what we call in a supply deficit, where demand for the metal was higher and supply was lower. That was the instance in both the cases. Silver had a bigger supply deficit. So silver was in a deficit of 20%, gold maybe about a 1 or 2%. So the hypothesis was that because there is a supply deficit, if the demand goes up, prices will rally very strongly, right? That was the hypothesis. The question was, where will the demand come from? So in case of gold, the demand did not come from investors. It came from central banks, right? So at that time, we had no idea who will be the new buyer, but it turned out to be the central banks. They had already started buying about 3, 4 years ago, 1,000 tons per annum, but that buying continued. It remained as strong as it is today.
Yeah.
And that is one of the reasons why gold prices started moving higher. In case of silver, the demand came from two places. One was technology demand which started to rise. And the second reason for silver demand to go up now, very recently that we are seeing, has come from investors. So investors have started to become interested in buying silver. I think largely a reflection of the recent returns. So as you know, the key hypothesis or what drives the price of these two metals is the incremental buyer.
Right.
Most other factors that we hear on a day-to-day basis, for example, the dollar, or for example, that we hear interest rates, inflation, etc. These are all cyclical factors. So some of them may be useful, some of them may not be useful. But on the whole, I think it's a combination of these factors. Currently, it is driven by the buyers that I spoke about. In case of gold, it's central banks. In case of silver, it is investors.
Got it.
Yeah.
So as you mentioned that there has been a very long period of a rally in these both precious metals, and during a period of such inflation and geopolitical uncertainty, what would be your final advice to investors?
Sorry, am I audible?
Yes, I hope my audio is clear.
Yes, your audio is clear.
No problem. I'll just repeat that question, sir.
Yes, please.
So, what I wanted to ask you is, as you mentioned about how the precious metals have had a rally, and so in times of high inflation and a lot of geopolitical uncertainty, what would your
Yeah.
advice be to the investors?
See, first is that currently we are not in a high inflation scenario. In fact, inflation in India is at a multi-year low. And similarly, in let's say US or other countries, inflation is more or less close to averages. It's not very high. The second is that geopolitical tensions is also very cyclical. I don't know how to define it, but yeah, it's a currently we are in a midst of things which we haven't seen earlier. For example, we are the biggest problem that we are witnessing today is the trade war, and we are also having wars, which are traditional in nature. So both of them does make a case for people to prefer an asset like gold. And specifically, we've written about it that a lot of investors, which are institutional investors, for example, large pension funds or central banks, etc., incrementally they've been trying to diversify away from traditional safe haven assets like the US Treasury, or other bonds, and incrementally trying to buy more into precious metals. So that becomes a very positive backdrop for gold and silver, particularly for gold, because silver is still not a safe haven asset. It's more cyclical in nature. And so gold definitely gets a benefit. And second is that if when inflation is very high, it causes what is called financial repression, which means that if you hold any asset whose value is depreciating because of inflation, you are better off holding other assets which will benefit from it. So gold, in that sense, benefits from uh, you know uh, problems in other parts of the economy like high inflation, etc. So yes, in that case, I think precious metals benefit quite a lot.
Understood. Thank you.
Okay. So, moving a little away from gold, we want to talk about the IPO bubble. A lot of noise has been created in the Indian markets that we are currently in an IPO bubble, and also the US seems like it's on a brink of recession. So, what are your views on this?
First thing is that it's very difficult to say that uh, is something a bubble or not. So I will refrain from maybe using that term because nobody knows whether something is in a bubble or not. It is only in hindsight that we come to know. Are we at an extreme? We were at an extreme in 23-24, where the fundraising was very, very high. In 25, I think it has sort of cooled down. Now you're seeing a new wave of activity in terms of IPOs. but the numbers for 25 as of today are much smaller than they were in 24 or 23, right? So that is one very, very important consideration. Historically, we've seen that when IPO activity is very, very high, usually it is sort of a red flag, right? We saw that happening in 2007. We saw that happening in 2018, early part of 2017-18, and FY18. And now also in 23-24, we saw a very high activity. Why does that happen? Because think about this, when the seller is ready to sell at the price that he wants to sell, right? Because all the information that the seller has, the buyer doesn't have. It usually tells you that if they are ready to part with their equity, it may be a very good time for them, which means that the investors or buyers are already at a disadvantage. The starting point is disadvantageous. So in IPOs, you have to be very careful about two things. One, that the seller has more information than you have. Second, the seller is choosing the time of his exit, right? You as investors are not choosing the time of buying. So these two consideration makes the IPO market, slightly stacked against the investor. How to tackle it? Usually, we've seen that when markets are generally in a bad phase or recent returns are low, fundraising is difficult. At that time, some IPOs come out at a very decent price and a decent valuation, so they become more attractive. So as investors, I think if you are a new investor or an investor who invests only in mutual fund, logically you should be avoiding IPOs. You should put probably a blanket no on IPOs. It's much easier said than done. Or the second way is to avoid IPOs which are high on valuation. But for that, you need to understand valuation, right? But if you are a new investor or who does not have the time or bandwidth to understand valuations, then I think it's better to avoid it altogether.
Sure. And what are your views on US going into recession as soon as by the end of this year?
I don't have a crystal ball to say what will happen in the future. But if you split the US economy, you will find that a large part of the US economy is already in recession, which is the goods economy. But the other part of the economy is doing so well that the overall number looks very, very healthy, right? So currently, the US economy is still growing at close to 2.5%, which is what its long-term growth rate is, right? So I think the biggest sign of an incoming slowdown, because predicting recession is out of my syllabus, I can't do it. But an incoming slowdown will come from a slowdown in the technology sector, because that is the sector which is driving the US economy at this point in time, while most other sectors are either flattish or in a low growth phase. So all the heavy lifting is being done by the tech sector. So for example, if you look at the total US GDP today, it's about $29.5 trillion. So if it, let's say, grows at about 2% also, it will do about 580 or 600 billion, right? It will add that number in 1 year. The AI capex itself is now close to about $500 billion or $550 billion. So very large chunk of growth is coming from there. But you, of course, have to adjust it for $1.3 trillion in net exports or net imports, which subtracts from the GDP, right? So if you remove the external sector in US, internally, the whole of the economy right now is driven by the tech sector. If that sector slows down incrementally, then probably US economy also slows down. So whether it is possible or not, I won't be able to say with certainty, but is there a probability that it can play out in the next 1 or 2 years? That seems to be the case.
Understood, sir. So what I wanted to ask you was now your view on the overall equity markets, the Indian equity markets, uh, maybe for the remainder of 2025 and also the first initial quarters of 2026. Just wanted your broader opinion on
One thing is that there is no way to judge what will happen in the next 6 months. If I give you an answer, I'll be lying. So I have no idea. If you're asking me where Nifty would be in the next 6 months or 1 year, I have no clue, right? And if somebody gives you an answer, that person is probably lying, right? We have no way to judge stock prices over a 6 months to 1 year time frame, right? So, for example, let's say if we were doing this webinar in January 2020, nobody would have known what will happen in March 2020, right? It's like once in a 100-year phenomenon. So, having put that qualifier, what we can do is judge where the valuations are, right? Uh, as Ben Graham said, that the three most important words in investing are margin of safety. Right? Where is the margin of safety today? That is something which can guide us how to think about investing today. So when you look at the Indian market, you will look at equity markets. You can split it into, let's say, large cap versus mid and small cap. Right? When you look at the market as a whole, which means all capitalization put together, Indian markets are expensive, right? For example, our long-term multiples, if they are 17 or 18 times, currently we are about 22 to 25 times. So not an ideal scenario from a long-term perspective. But when you split by market cap, large caps are probably priced better than mid and small cap. Mid and small caps are more expensive. They are trading at about 30 time plus multiples, while large caps are trading between 20 to 22 times. This does not mean that 20 times or 22 times multiple is cheaper, but on a relative basis, there is some value. Now, when you split it down to sectors, you will see that sectors like BFSI or large private banks, some large IT companies, part of healthcare sector, some FMCG companies, you will begin to see that there are pockets where valuations are average or cheap, and there is a probability that if you participate, you can come out ahead in the market. Right? So you will have to be very careful in what you select. So preference in that order will be to go more towards large and largest cap companies, prefer these sectors which I spoke about, and then create your portfolio. If you want to do mid and small cap, the only way that you participate today should be through SIPs. I think if you do SIPs, I think you probably will come out better ahead. But this is the overall complexion that I see. And the reason for that happening is that our market is, as I said, let's say NSE 500 universe trades at 25 times multiple. Right. Overall return on equity for the index is around 15%. For 15% ROE, you need at least 15 to 18% earnings growth. But currently the earnings growth is less than 10%. And therefore the margin of safety is absent. And that is how you should think about it, that if earnings are not going to grow at 15, 18%, then I'm better off buying only in places where valuations are lower.
Sure. Got it. Great. You mentioned about themes. What macroeconomic factors do you think an investor should keep in mind during times like these? Would you give a lot of weightage to inflation volatility, interest rates, and fiscal policy volatility? Or should a retail investor be worried? And also wanted to understand, does your strategy also get influenced by these factors?
First thing is that I don't know any investor who is not worried. People are worried all the time. So that is how we are. And we get excited and positive at the wrong times. So the most important factor to keep in mind, as you said, out of, let's say, inflation or macroeconomic themes or fiscal deficit, or there are many things that we can enumerate. But I would say that the investors, I will probably quote Ben Graham here, where he says that investors' chief problem and even his worst enemy is likely to be himself. Right? It's not inflation or anything else. It is our own behavior that is the biggest problem. When you pick, let's say, specifically macroeconomic factors, I think there is no greater factor than interest rates which impact the economic outcomes, right? Because they can directly impact the outcomes for investors and for corporations. The second most important factor is inflation, right? And why do I pick these two? Because at extremes, they can cause a lot of damage to earnings potential of the companies, right? And therefore, they become much more important, given that the other factors are, very, very, you could say, murky. You can't really pick and choose in any specific order. Right. Second and more important thing, we should know our limits in predicting these numbers. For example, there is no scientific way or mathematical way to judge what will be the interest rate 1 year from now or what would be the inflation 2 years from now. All are guesstimates, right?
Yeah.
So we don't know. And therefore, investors should use them as inputs, not as predictions. This is very, very important. Using these numbers as inputs to your decision making rather than predicting them and then taking decisions. And third, and probably going back to my first point, where I said that the chief problem is us, not the macroeconomic factors. I think if we cultivate a disciplined approach to investing, then we can take care of most of these factors. If our approach is disciplined and if we build a margin of safety in our purchases, then most of these macroeconomic factors get taken care of.
Okay, so one final question. What advice would you give to a new investor in the market, especially young people who are confused between picking direct stocks or going the SIP route? What advice would you have to give them? And also looking at the current market scenario, one tip that you would tell them, that helps them stay invested for the long run.
First thing is that as new investors, if you want to become what Ben Graham said, enterprising investor, where you want to learn stock picking and want to understand how this stuff works, then first divide your portfolio into two parts. 95 to 97% of your portfolio should go to mutual funds, where there is a manager who is managing your money. Most likely choose a systematic investment plan. Start it and just forget about it, shut it down. Don't think about it. That is where bulk of your investment should go. What kind of funds you should choose? Well diversified, probably a multi-asset or a hybrid strategy. That should be a starting point rather than picking an equity fund if you are a new investor. And with the rest 3% or 5% of your portfolio, do whatever learning you want to do. You want to pick stocks, you want to do FNO trading, but make sure that you do not add money to that account. So for example, if you start with 1 lakh rupees and you have 3 lakh rupees of learning money, if you exhaust that 3 lakh rupees, your investing career is over. You go back to mutual funds and stick with your portfolio, right? But if you are able to carry forward and continue with that funds, then probably in a 10-year time frame, you will be able to diversify your book to your own investing strategy. Second and more important point for new investors, do not focus on returns. Investing is about compounding. And in the formula of compounding, the most powerful term is time, because that is the exponent. It is the raised to the power time. So the longer you multiply in terms of time, the best outcomes will happen. So for example, most investors are focused on achieving high returns. They want 20%, 25 or some outrageous number. But if you compound at a decent rate, inflation plus some percent, and for a very long period of time, your outcome will be much more superior than by chasing high returns. So always focus on time rather than focusing on returns.
Got it. Understood, sir. So that was all I had to ask you. Thank you so much for joining in, and thank you so much for an insightful conversation. Also, to all the participants, we hope Sahil sir's expert views on gold, silver, and the IPO landscape, along with global economic trends and the future of Indian markets, have given you new perspectives, certain amount of confidence, and also, I hope this helps you in your investment journey. Stay tuned for more episodes like this, where we bring you leading voices and actionable ideas to help you navigate in today's complex financial world. Until next time, keep learning, keep investing, and take care. Thank you so much, Sahil sir, for joining in. Thank you so much.
Thank you very much.
Thank you so much.
Thank you very much.